Something's changing inside of Google, and almost nobody's talking about it. For years, Google was that wild growth-driven company, throwing ideas at the wall just to see what stuck. But lately, they've flipped the script. Instead of chasing every shiny new project, Google started doing something completely different. Something that quietly makes investors very, very happy. Most people still picture Google as a teenager company. Risk-taking, experimenting, always curious. But somewhere along the way, it grew up. Now, Google's acting like the adult in the room. Focused, disciplined, and finally taking care of its investors. Stick around, because once you see what Google's really doing here, you'll never look at this stock the same way again. For most of its life, Google's story was simple. Growth at all costs. Ads were printing money, so they poured cash into everything. Phones, maps, cloud, even self-driving cars. It didn't really matter if a project made money. The idea was, hey, as long as search keeps paying the bills, why not swing for the fences? And to be fair, that worked for a long time. Investors didn't mind the chaos because every few years, one of those big bets did work. Android, YouTube, Chrome. But then something shifted. Growth started slowing. Costs ballooned. Investors stopped cheering and started asking, okay, where's all this money going exactly? That's when Google began to change. Quietly at first. Cutting projects, tightening spend, and talking more about efficiency rather than expansion. And that's where this new version of Google starts to emerge. One that's less obsessed with being first everywhere and more focused on doing fewer things better. So what's different now? First, Google started returning cash to investors. Big time. We're talking $60 billion in share buybacks over the last 12 months and a dividend that, while not huge in yield, still pays out $10 billion a year. That's serious money. Next, the company got smart with its balance sheet. They're not hoarding cash or spending blindly anymore. If debt is cheap, why not use it to boost shareholder returns? And Google has the capacity. Low debt, massive cash flow. It's almost criminal not to. Let me explain why this is important. When we say debt is cheap, we mean the interest rate is low. Google might pay only 4 to 6% interest, but their stock can return 15 to 20% a year. Buying back stock basically captures that spread. They earn more on equity than they pay on the debt. What do you think about Google using debt this way? Smart move or a little too risky? Drop your thoughts in the comments. I'd love to hear what you think. Even internally, the change is visible. Projects that didn't deliver were cut. Teams had to justify their budgets. No more throwing money at moonshots that might never pay off. Innovation didn't stop, it just got disciplined. All of this shows Google is now squarely focused on shareholders. Cost efficiency, focus, and predictable returns are taking the front seat. This lets Google put even more firepower behind the strongest bets for the future. Even though Google's revenue growth has slowed to 13%, the company has been remarkably efficient. EBITDA margins are around 38%, and net income margins have climbed to 31%, well above the 20% median. That means even with slower top-line growth, earnings are still expanding. EBITDA growth is running at about 25%, higher than the 21% median, and net income growth follows a similar trajectory. Google is putting those earnings straight into the hands of investors. Over the last 12 months, they've bought back $60 billion of stock and started paying a dividend of $10 billion. That's a major shift. The share count, which used to grow at 1 to 3% annually due to stock compensation and acquisitions, is now declining 1 to 3% per year. And Google isn't afraid to use debt either. After years of minimal borrowing, they now carry around $23 billion of debt, still very low relative to their earnings. Here's why that matters. Companies are generally considered safe to borrow up to about 3 times their EBITDA. Google's EBITDA is at roughly $140 billion. That means they could theoretically take on up to $420 billion in debt before investors would start to worry. That's massive firepower. Google can use it to buy back shares, pay dividends, or invest in AI and other high potential bets, all while keeping the business safe and disciplined. All right, let's talk numbers. Right now, Google trades at a forward PE of about 25. Some people will tell you that's expensive, but they're forgetting one thing: growth. For a company expanding this fast, that multiple actually makes sense. Now, to stay conservative, let's say earnings grow at about 18% per year. That's a touch below the average of roughly 20%. Let's also assume the market brings that multiple back down, closer to Google's historical average of around 21. Run those numbers and here's what you get. About 90% return over 5 years. That's roughly 8% from today's price if the stock were priced for S&P level returns. So even if growth slows a little or the market gets picky about valuation multiples, Google still looks like it can deliver strong returns for investors. So here's my take. Google today looks fairly valued, but that doesn't make it uninteresting. You don't always need to swing for a home run. Sometimes a solid base hit can move your whole team forward. And in this case, your team is your portfolio. This is a business that's already generating massive cash flow, running more efficiently than ever, and finally learning to use its balance sheet as a weapon. The AI boom is forcing every tech company to evolve, and Google's response has been quiet execution, not chasing headlines, but strategically using debt, buybacks, and dividends to compound shareholder value. At this point, the risk feels tilted to the upside. In the worst case, you probably just match the market. But if AI-driven efficiency, cloud growth, and disciplined capital returns keep compounding, the upside could be much greater. That's why I think Google is such a powerful anchor position. It's still got an incredible moat around search. It's one of the most profitable, data-rich businesses on the planet, and it's finally focused on turning that strength into consistent returns for shareholders. If you stuck around this long, leave a comment. Let me know what you found useful or where you disagree. Otherwise, join me on Discord. I'd love to hang out with other investors like you. Thanks. Bye.